Yes, I can get you.
So you can just submit them on WhatsApp, and that will also enable me to attend them as quickly as possible. Anyway,
Yeah,
let
yeah,
us
yeah,
now
yeah.
push to week two. All right. So we need to ensure that by the end of the first month, we'll have covered week four. All right. So in the previous week, we talked much about the conceptual framework so that we understand where we are coming from in terms of the accounting theory. Then, in this week, we'll also expand a little bit from the aspects of IFRS 18, which we covered last week, but with a focus towards the presentation itself of financial statements so that we get to the grips of the whole thing. Because if we are not conversant with IFRS 15, IFRS 18, it is going to be very, very difficult for us to attend to a variety of questions in accounting, actually in financial reporting. So we'll touch
Mhm.
on the aspects of IFRS 18, and then we move on to basic groups, that is in line with IFRS 3 and IFRS 10. Okay, IFRS 3, that's business combinations, and IFRS 10, consolidated financial statements. So those are the things, but we are going to look at basic groups, those groups we did at undergrad, largely, or at financial reporting. Then in the coming week, we'll then tackle the complex groups and so forth. Why are we starting with these? This is because as we proceed with the study journey, you would see that if you are already comfortable with the consolidated setups, then the rest of the standards are going to be easy for you. And the second reason is that our study journey might be clouded with a lot of inflexibilities, time challenges, and so forth. So if we cover consolidations, cash flows, all those things, we'll be ready to attempt this exam. Remember, the first question which attracts 40 marks, 30 marks, is actually a consolidated question, consolidated financial statement question. So we need to at least ensure that we have covered this subject area as thoroughly as possible. Is that clear?
Yes, it's very, very clear. Thank you very much for that one. We can get into it.
Thank you. So um, let's talk about the primary financial statements framework. If it's 18, supersedes IAS 1. Uh, Previously, we used to work with IS 1, that is presentation of financial statements and so forth. That standard is no longer applicable. What is now applicable is IFRS 18. All right? IFRS 18, and
Mm.
you should be comfortable with its name, its real name. Okay, because it's something that is annoying or disappointing to examiners if you say this is if it's 18 but you are quoting the name of IS1. That is going to annoy the examiners. All right, so if it's
Yes.
18, presentation and disclosure in financial statements, you need to be comfortable with this standard, please. So it supersedes IS1 to enforce consistency and eliminate custom corporate classifications in performance reporting. So there is the performance focus, where the standard introduces disciplined structures to the statement of profit or loss. I will show you the structure as we proceed with this session. The second thing, it gives us the idea of what the complete set of primary financial statements looks like or comprises of. All right. So it includes the profit or loss statement, All right. The profit or loss statement is now called the statement of financial performance. Statement of financial performance. What is the financial position, that is the statement of financial position, still retains its name. Okay, it's still the statement of financial performance, the SFP. Then there is the statement of changes in equity. That one again still retains its name. Then the statement of cash flows, again, it still retains its name. Then the notes to the financial statements are still the notes to the financial statements. And then the comparative information, that one is also part of the package.
Okay.
Right. Now, the new profit or loss architecture. There are now 5 distinct categories of the statement of profit or loss. All right. So there is the operating activities section. All right. This is the baseline. The baseline cash or block. It houses core activities not designated elsewhere. So, in essence, the entity's basic or the ordinary business activities are going to be housed in the operating activities section of the profit or loss statement. Then there is the investing activities section. This one is an independent is for independent asset returns from associates, joint ventures, and financial investments. So all those things, all those incomes we are going to drive from investing in associates, joint ventures, and financial investments are going to fall under the investing activities section of the statement of profit or loss. Like I said, don't worry, I'm going to show you the sample statement of profit or loss according to the new standard.
Okay.
Then there is the financing activities section. This tracks financial source adjustments, long-term borrowing costs, and debt flows. All right, but now you also appreciate that when you are talking of operating activities or financing or investing activities, the nature of the business is also going to be very, very instrumental. For example, if you are looking at financial statements of the bank, you discover that the main purpose of or the main trade of this business is to accrue income through investments. So investment income is not going to be put under the investing activities. Why? Because it is the core or the normal, the ordinary day-to-day business. So it is going to be under the operating activities. Are we together?
Yeah.
Good. The remaining 2 categories are the income tax section. There's going to be an income tax section as well as the discontinued operations section. So the first 3 actually, or let me just say the first 4 are to do with continuing operations, whereas the discontinued operation is going to be the last of the category. Okay.
Okay. Yeah.
Now let's look at the investing category. This captures returns generated independently of core day-to-day business actions. So we'll be looking at passive income generation. For example, external dividends received. If a company has got some shares in another company elsewhere, all right, the dividends that is declared in those companies is going to be income under the investing category, like I said. Asset
Yeah.
rental streams are also going to be reported under the investing category. And interest earned on non-operational cash balances are also going to be reported under the investing category. For example, you put your money, the company money, in your corporate bank. When that money earns some interest, it is going to be reported under the investing category.
Okay. Okay.
Joint arrangements. These ones fall under which Ifrs? That's Ifrs 11, if you still remember. Ifrs 11, joint arrangements. However, when you are preparing this statement of profit or loss, you also need to report it under. I mean, the incomes from those from those arrangements is going to be under the investing category. The group share of profits or losses from equity accounted associates and joint ventures is also going to be reported under this. What about structural gains? All right. So when we are talking of structural gains, we are simply talking of step acquisition adjustments and capital disposal realizations. All right. So sometimes we might dispose of a certain, for example, you might have a startup business and you decide to just spin it off. You know, those the aspect of spin-offs. Have you ever heard of spin-offs?
Maybe that one inoitwa ni team runoita njuga.
Okay, all right, all right. You might have a company, but you have decided that it is not really complementing your strategy. Maybe it was part of the portfolio. For example, you are mainly into building, but at one point in time, there was an upsurge or a high demand of those for example the respiratory masks, the face masks during the COVID, for example. Then you decided to say, oh, there is high demand of these guys, of these items. Can we just enter into that market? Or for example, you are even if you're in construction, but you have determined that water in Harare is actually something that is paying off. Then you decided to venture into water, bottled water business. All right. Then after some time, you then discover that no, water is no longer something that is bringing money. So you decided to dispose of that, uh, that business. All right. Or even the disposal of non-current assets in general. Are we together? To just say, okay, fine,
Yeah,
this building, we
you
know,
are very clear.
yeah,
You are very clear. You are very clear. Thank you on that one.
yes. So we no longer need this business. Let's just dispose of it. So
Yeah.
those are just what you might get, what are called gains on disposals. It's still
Yes.
the same thing. We used to do this. All right. There were gains on
Yes.
disposal.
Yes. 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 Yes.
Do get it.
Yeah, I'm
We
getting
used we
you.
used to say we used to say other income gain on disposal. Yeah, all right.
Mm, mm, mm.
But now that gain has to be under the investing category. It cannot be reported in the operating activities. Why? Because it is not our core business to dispose of
Oh,
our
yeah,
company
yeah,
offices.
yeah, yeah, yeah. Mm-hmm, 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 mm-hmm.
Do you get it?
Yeah, you are on it.
We cannot have that amount or those monies under the operating activities. Why? Because they are not. a day-to-day or the core mandate of our business to sell our office, our offices or whatever. Those are just gains which have to be reported as investment items. So they are going to be an investing category.
Sorry,
Correct.
just before you move on, sorry, can I just draw back you to joint arrangements just a bit?
Okay.
Maybe Mukango put another emphasis here.
But okay. Joint ventures. Joint ventures, like I said, they are under IFRS 11. Okay,
If it's
there
level
are two
yes.
types of joint arrangements. Okay, uh, there are joint ventures, and the other one is a joint operation.
Yes, yes.
Okay, so joint ventures themselves are accounted in the same manner as associates. Okay,
You
when you're talking of an associate is not is a company uh, which in which the investor has got some influence. So influence is only seen basically through the shareholding, which should be above 20%, but not exceeding 50%. Okay,
yes, that's
that way
associate.
we can
Yes,
say
yes, yes, yes.
there is significant influence. Okay, if the
Yes, yes.
investor has got less than 20% of shares in another company,
Mhm.
that type of investment is just a simple investment, and it is accounted for in terms of IFRS 9, that is financial instruments.
Yes.
All right. But if the investor has got more than 50% in another company, then that company is called a subsidiary.
Yes, 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 yes.
You get it?
Yeah, I get it. Yeah, that's
So,
cool.
in this particular situation, we are saying if the joint arrangement is a joint venture, then you need to account for whatever income or whatever dividend from that uh, under the investing category.
Okay, okay.
The same way you are going to account for the share of profit of associate, it is also going to be under the investing category.
Mhm. Yeah, you are clear. Thank you very much. Thank you very, very much. I think I get it. I get it. Thank you very, very much.
Okay. But in the course of the week, I'll come back to you when I also need to find out how we have to treat the income from a joint operation. All right, because a joint operation, usually we it's like a subsidiary in a sense. All right, because we do line by line, uh, you know, line by line consolidation. So
Mm-hmm.
it's a line by line consolidation. It's not equity accounting. All right. In equity accounting, we are simply interested in the net assets of the business. That is the profit, the share of profit. This is why we are saying it is going to be the joint venture is treated the same way as the associate. The way we treat the
Mm-hmm.
associate profit, that's the way we are also going to treat the joint venture profit in this case, right? So for the joint operation, what actually happens is the way we are going to treat a subsidiary is also the way we are going to treat the joint operation. Do you get it?
Yeah.
All right, don't worry. We're going to do the consolidation, where we are saying
Okay.
we are expand on this aspect of line by line consolidation. For example, the assets we're going to add the assets of the parent and the assets of the subsidiary, and we get the total assets. All right, that
Mm-hmm.
one happens when we have got control over over the investee or control of the subsidiary. So we do the line by line consolidation. That is, we add across the assets of the subsidiary and the assets of the parent are added together to come to the total assets. The liabilities will do the same. But when it comes to equity, only the shares of the parent are going to be considered, and the reserves of the parent as well. So,
Okay.
hello,
Yes, I can hear you, sir.
good. So don't worry, we are going to arrive at that.
Okay. No, that's fine. It's okay. But I am following. It's singing.
Is it singing? Oh, maybe
Yeah,
it's confusing.
it's very straightforward. You are explaining in a way that I can adopt.
All right, that's fine, that's fine. So here is I mean, an exam highlight. Do not blend income from equity accounted entities with operational income. They are presented separately within the investing section before taxation lines. So we are simply saying that the incomes which, like for example, is coming from equity accounted, like for example, the associates where we are having shares, equity accounted, we are having shares. There is some significant influence in those companies. All right, there is some significant influence in those companies. So if there is significant influence, we are not the owners, or we do not have control over those companies, but we have got significant influence. There are some indicators of significant influence. For example, we have got the power to nominate one of the directors. For example, the company has got a five-member board, but we can appoint one of the directors, okay, or even two of the
Mhm.
directors. If we can appoint two directors out of five, we have got significant influence, but we do not have effective control. Okay, but in the
Yeah.
case of a subsidiary, we can appoint up even all the directors, or three over five or more. All right, three
Yeah.
of the five directors, we can appoint them. Can appoint four. We can appoint even five. All of the directors. Why? Because we have got control over the investee. We have got power over the investee. All right. So
So.
in equity accounted, what we
Mhm.
only take is the net income, the share of the profit. That's what we have to report under the investing category. Is that clear? But
Yes.
but
Mhm.
if it was a subsidiary, whatever the operating income, we're going to put it directly to our operating income in the parent. If it is
Mhm.
the operating expense, we're going to take it as it is and add it to the operating expense of the parent. But now, because this
Mhm.
one is an equity accounted, we only have to take the net profit or the share of the profit. That's what we are going to include in our investing category. Is that clear?
Only the net profit. That's what we are going to take for equity accounted entities into into our group under
Ye-
investing
Yes.
category.
Yes.
Okay. Yeah, this is very clear what you patsanangura chaipo ende ndinoona patone issue yekuti sometimes I might mix up ndichiti sub operational income is specific, it's our primary focus saka normally iri subsidiary, that's when I can take ningi yekusubsidiary ndichiuya ndichiisa paoperational income. But if it's my associates, maybe like what you're saying, maybe kana ndine two out of five, ndine power 2 out of 5, maybe mashares angu ndichikwanisa wapointa 2 out of 5 directors, that's when I can take net
Yes.
net
Yeah, net
ndichiisa
the net earnings.
investing.
Yes,
Net
or the share of
earnings.
the net earnings. That's when, because when you can appoint 2 out of 5, then there is what is called significant influence. But sometimes when you can appoint 1/5, and there is some contract that gives you the influence, then you still have got the significant influence. But being able to appoint 1/5, to some extent, because what happens is the percentages, remember the percentages, 20%, 20%. So if 1/5 is 20%, you still have got significant influence. But sometimes the board might be a 6-member board and you can only appoint one director. So 1/6 might end up to be 15%. So in that case, you do not have even significant influence. So that is a simple investment which has to be accounted for under, you know, has to be accounted for under IFRS 9, that is financial instruments. But you need also, because remember, it is not about the board representation, but it is about shareholding. So it's a combination of shareholding, and sometimes the shareholding might be 25%, but you can only appoint one director. So if the shareholding is above 20%, there is significant influence already to get it, even
Mhm.
if you can appoint one
Yes.
over six of the director. So, first of all,
Mm.
look at the shareholding, then from the shareholding, go to other aspects.
Yeah, very clear.
Okay, let's move on.
Yeah. Thank you.
The financing category. Um, this one includes pure financing liabilities. It captures structural funding costs, okay, those interests, the interest costs, including interest expense from banknotes, corporate bonds, and debentures. So if we borrow money, obviously we are going to pay interest, and the interest cost is going to be under the financing categories.
Yeah, very clear that one.
Mhm. Other financing costs, this one houses accounting adjustments related to the time value of money, such as if it's 16 lease liability interest adjustment. Remember, when we do leases, there is the lease liability adjustments related to the time value, or remember the present value aspects. Remember, a lease liability is actually the present value of future lease payments. Do you understand? So when we are now discounting, unwinding the discount, there is what is called the balancing figure. There's going to be called some adjusting some adjustment, all right, or adjusting costs. So those ones are also going to be reported under the other financing costs, although they are not related to bank loans, but because the unwinding of the discount leads to those interest costs. Do you get the idea?
Yeah,
All
I'm
right, don't
following.
worry, don't worry. Okay, don't worry.
Okay.
Right?
Yes,
Um,
yes, yes.
there is what is called lease amortization. When you are paying your lease, all right, you are reducing the lease liability. But remember,
That's
at the first, because the lease is going to be paid or is going to be over a long period of time, you need to come up with the present value of those lease payments. But annually, as you be paying, you are actually unwinding the discount to come to the real value of the money which is required. So, in making those adjustments, that's when you will see that there are some certain balancing figures which are going to be accounted for as finance costs. All right. So,
okay.
w- yeah, yes, when we do leases, you appreciate what I'm talking about. So, this is why I said we need this foundation to get
Oh,
some
yeah.
introduction so that when we
Yeah.
then visit the standards themselves, because remember, I have
Mm,
indicated here that this one is related to IFRS 16. All right. There are a
mm,
lot of standards
mm,
with this, even the provisions, contingent liabilities, and so forth. It also has got some aspect of discounting, okay, unwinding
mm.
discount and so forth. So those are the things we are talking about. Even IAS 19 on employee benefits, there is what is called the net interest charges on defined benefit pension deficits. Those ones again are going to be under the other finance costs. So the
Mhm.
main category here is the financing category, but it has got two sections. There's
Yeah.
there are financing costs which
You are
are
financing.
emanating from pure financing liabilities,
Mhm.
as well as
Mhm.
the other financing costs. So be careful.
Yeah.
I mean, take notice of this.
Okay. 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 So it simply mean that I have to highlight maybe on my ningi on my panel chigadzira accounts angu kuti I have to highlight that this is financing. It's
Mm,
not only it's pure, I mean pure financing liability, then ndoisa my interest on loan bank chakuti then other financing costs I put under you
okay.
ndakusa.
Hello. All right. Sometimes it's not about you putting a specific subheading, pure financial liabilities. All right. But we can say if there are many, for example, you have got uh, capital, structural funding costs, which include if you have got interest expenses from bank loans and
Mm.
interest expenses from corporate bonds, interest expenses from debentures,
Mm.
as separate transactions, then you might then have to come up with a subheading, pure financing liabilities under the financing categories. Okay, under the
Mhm.
financing activities. You understand? But
Mhm.
sometimes if it is only one entry, for example, interest expense from bank loan, this one again, you just have to write to make an entry on the statement of financial performance under the financing category to just say interest expense one line and then other financing costs. That's when you then have to include, and if there are so many again, um, you can as well put in a subheading further financing cost, other financing costs. But if they are not many and there's only one entry related to leases, I don't think to put a subheading will look nice. So you simply just have to say interest expense, then uh lease liability interest adjustment, all right, is another entry. Do not bunch them. That's what the standard doesn't want. Do not simply just say these are financing costs and then you bunch them, because they are different in terms of risk, in terms of the liquidity, all those things. They impose different risks. So because of that, they need to be given separate entries. Do not bunch them.
Okay.
Do you get it?
Yes, I get it.
Good. So let us discuss about the main business activities, the MBAs, exceptions. There is now a rule shift. When an entity's primary business model relies on investing assets or extending finance, relevant elements shift into operating profit. We talked about this, where we are looking at pension funds or investing entities, financial institutions. You discover that what what gives them money is through borrowing and lending. Is that clear? So in that case, the type those interest earnings or interest incomes are not going to be reported under the investing activities like what the ordinary businesses do, but they are going to be part of the operating activities.
Mhm.
Are we together?
Yeah, that's very, yeah, it's very it's differentiating Niki. But sometimes yeah, yeah, mapatsanangura chaizvo chaizvo. But I think I need to revisit ndaendega futi ndichizoti zvinyatso kusinga but munonyatsa kupatsanangura.
Maipota makes advantage. Saka, you're going to the examiner is so generous, is so actually caring, because in the scenario they will tell you the nature of the business as you'll be reading it that this one is a bank. So if it is a bank, you know, say If it is a bank, then no way those items are going to be put. All right, a bank, a
Mm-hmm.
pension fund, those guys, they in their day-to-day business is investing. So
Mm-hmm.
investing income is actually their part of their operating profit. So it's an operating activity for them.
Mm-hmm.
All
So
right,
nature of the business is key.
AI is key.
Okay.
Okay, now there are going to be some subtotals, the aspect of aggregation, and the end of the other. We used to have other income, right? So
Mm-hmm.
it's no longer an aspect of other income, but you are going to say other investing, investing income or something like that. All right, you need to be specific of this other income. Is it other investing income or other operating income or other something like that? But basically, they do not want okay some vagueness. Okay, this standard is about more transparency. Okay,
Mm-hmm. Yes.
so there are three mandatory subtotals. We need to see in your statement of profit or loss. We need to see clearly the operating profit or loss. We need to see that amount. Then we need to see the profit or loss before financing and tax. That amount is to be seen. Then final net profit or loss. That is the profit or loss figure, the final figure has also
Mm-hmm.
to be seen.
Mm-hmm.
So
Mm-hmm.
these subtotals. Chero makanya, chero madumbigwa, exam yabaya, ofa gumashaya wae, ma subtotals aya afa ngushayigwa.
Mm-hmm. Mm, yeah, that's very true.
Okay. Then
Mm.
uh useful structured summaries. Uh when you are presenting your statement of profit or loss, right? What we are seeing there are the useful structured summaries. So, for example, if we are looking at the operating activity section, the investing activity section, what we are seeing should be a useful structured summary. All right. It
Mm-hmm.
should be summarized, but at the same time, it should be useful to the user, not just a summary. So, this is why I said do not bunch these things with the view of summarizing data. Because if you bunch them in an attempt to summarize, you might end up coming up with a summary that is not useful.
Okay.
So in
Okay.
your summary, it should attend to aggregation where as far as possible, right? But at the same time, it should be having the transparent aspects. So things which can be bunched should be bunched, which should not be bunched should not be bunched. So items must be classified by nature or function. Loose aggregation is prohibited. So you need to look at the risk of the item, the liquidity impact of the item, actually the materiality of it, and so forth.
Mm-hmm.
No broad labels. Generic entries like other expenses are discouraged. Use
Mm-hmm.
descriptive breakdowns instead. Like I said, other operating expenses is more clear than simply saying other expenses. Do
Yeah, it's clear.
you understand?
Yes.
Yeah. So you need to be very, very clear. But anyway, we are going to show the model, and here it comes. So you can see, generally, it's still the old statement of profit or loss. However,
Okay.
however, like I said, the operating profit is mandatory, is mandated. This one. We need to see the operating profit. So you can see that what we are going to start with these first items from revenue. Unfortunately, today I don't have my pen, my tablet. Okay, so actually from here down, that's the
The
operating
operating
section,
section category.
the,
Okay,
the
that's fine.
operating category.
Nah, no, that's
All
fine.
right, so we start with the revenue less cost of sales. We used to do this. So even if, so this is why I've just said, please, chero zvawo haufaniri kuzoshaiwa subcategories, because it's still the same thing, but it is a little
Okay.
bit more organized. All right.
Yeah.
Then other operating income. Don't just say other income. Other
Other
operating.
operating income. So
Okay.
now, other operating income, it's a balance. Yatiri kungozoisa apa. Maybe my question now on that one is to say, if you have other operating income, maybe there are three or there are two. Are you saying with the balance ndrungoaedha kumanotes kunoku ndozongoya ndoisa balance up or something?
Yes, yes. We are saying this is income not from the ordinary sale of,
Yes, 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 yes. Operation
yes,
of the
the
business.
ordinary sales, right? So,
Mm,
for example, mangotengesa motor in, all right,
mm,
matengesa motor. Motor is not a capital
mm.
asset, all right?
Yeah. Mm.
It's not a capital asset, which we say, we say it should be under the investing activities. If you still remember.
Yeah, 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 yeah.
Investing activities, if we sell capital items, you understand?
I understand.
Capital, items of capital nature. But
Yeah.
here, if you sell, office furniture which you no longer need and so forth, and you make some gain, so that gain is in other operating income, and it should be, you know, under this first part. Do you get the operating
Okay.
section?
Yeah. I get it.
Then sales and distribution expenses, research and development, goodwill impairment, uh, other operating expenses. Don't just say other expenses. All right. Of course, all these will be having some notes. Largely, most of these will be having some notes. It's very rare
Okay.
to have. It's very rare to have a common amount that is going to appear without some notes. It's very rare.
Yeah, it's very rare. That's very true.
You understand? Then
Yeah.
you get your operating profit. After that, you move on to the share of profits of associate. So you can see that under the exam, you need not to be too specific about the writing the operating category section, investing
Oh,
category
yeah, yeah, yeah,
section.
yeah.
You can see,
Yes, I can
but
see it. I
I will
can
show
see it.
you. I will also show you the standard by the examiner. I will also show you that is going to have all those sections presented.
Okay, thank
All
you.
right.
Thank you.
So here, the share of profit of associates. What you need to see here is that originally in the previous standard, the share of profit was usually going to be found is among these other things. But here, the share of profit is under the operating profit to signify that it is not within that category of operating activities, but it is something which is now in another category, and this is the investing category. Do you understand?
Hmm. I understand.
Yes, it's an investing category. This is why it is under the operating profit. Well, the operating profit or loss actually signifies that we are done with the operating activities. All right.
Yeah.
Then we move on to the profit before financing and income taxes. I said this one again was a mandatory. You
Yes,
still
you
remember,
said
right?
it. Yes, you
Good.
mentioned it.
The examiner would want to see it. All
Yes,
right.
yes, yes.
And then we talk of interest expenses on borrowings, interest expenses on pension liabilities.
Oh, yeah, that one, that one, that one. Yeah, 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 yeah.
You see, you must not
Mm,
bunch them to just say interest expenses. Please separate them. Okay.
yeah, yes, okay.
From there, we go on to profit before income taxes. All right. Not just
Yeah.
profit before, don't say profit before tax. They want you to say profit before income taxes.
Mm-hmm.
Then we then adjust for the income tax expense. Don't simply say tax. People will be tired in the exam hall. Don't simply say tax. They want you to write income tax expense. That one.
Okay.
And you say profit from continuing operations. You get this amount. Then, but remember, the three mandated are this one, that one, and
The
this one.
profit or loss. Mm.
Not the profit from continuing operations. No, it's not mandated. But the standard wants it. Okay, but the standard specifically said these three are mandated. Okay. But in the model,
Yeah.
the model is statement of profit or loss by the standard. We have got these other, you know, uh, subtotals. But the mandated ones, operating profit and profit before financing and income tax, and then
Yes.
the profit. It is no longer profit for the year ended. It's just a profit. Okay.
Or loss. Or loss,
Or,
huh?
or, or loss. Simply just say loss. Don't write a lot of
Okay.
words because investors are complaining. They want it to be very easily detected.
Or it's taking a lot of their time to read the loss for the year
Profit
end.
for the year ended, I or profit for the year. I, it's no longer, just have to
Okay.
say profit.
It's okay.
Okay. And but first of all, you need to factor in the loss or profit from discontinued operations, and then you come to your profit.
Okay.
All right. This is a magnified one, a magnified version from the examiner himself. Okay, for consolidated statement of financial performance. Like I said,
Mm-hmm.
this is now the new name. Please be careful. All right, for the year ended 31 December. Right,
Mm-hmm.
and the name of the company should be prominent on top there. Then
Mm-hmm.
remember, this statement of financial performance includes two statements. There is the statement of profit or loss, which we have just seen here, and there is
Yeah.
also the statement of other comprehensive income, which will be below. Okay, the statement presenting other comprehensive income.
Okay.
Do you understand? The
Yes.
OCI,
I'm following.
the other comprehensive
Yeah.
income. But now it is statement presenting other comprehensive income for you to be a standing out student who is aiming to get the 90% and above marks. All right. So, like I said, we start with income and expenses from operating activities. Examiner is very stylish, but maybe under exam scenario, exam conditions, hey, to come up with all these might be difficult, but this is the standard. So we start with the revenue as usual, less cost of sales. We come to gross profit.
Yes, yes, yes.
Then we come to other operating income, if any, you put it there. Then we come to operating expenses, as we have just seen, and we come to what is called the operating profit. Operating profit is signifying that we are done with
Operating aspect.
the
Mm.
operating aspects,
Okay. Yeah. Very
right?
clear. Mm-hmm.
Yeah, so which means we must not see these goodwill impairments under other categories
Yeah,
here
yeah,
because
yeah, yeah, yeah.
they are expected to have been catered for.
In the operating category.
Yes. Then
Okay.
we come to another segment, income and expenses from investing activities. You understand? Then that's
Yes.
where we have the share of profit or loss of associates and joint ventures.
Mm-hmm.
Then other investment income. The other investment income, like I said, you can bunch them and come with the figure here. But you need to mention that it's other investment income. And we have shown you what they include, the adjustments on leases, adjustments on pension, defined benefits, pensions, and so forth. Those are going to be the other investment income. No, no, no.
Mm-hmm.
Those ones were finance costs. I'm sorry for that. Um, the other investments, do you still remember of any?
Other investment income.
Yes.
That one, share of profit or loss of associate or joint ventures. I'm sure
We
that's
talk.
where
We
we talk. We put emphasis.
All right. We
Then
also talked of the structural gains, capital gains,
oh
structural capital
yeah,
gains
yeah, yeah, I remember. Yeah.
when we dispose
Yeah.
of capital items. You understand?
Mm,
Yeah, the
mm.
capital items, uh, items of capital nature. You know, the capital
For
items.
example, for example, can I recall that example, Mapa?
All right. This is your assignment actually
Okay,
on these capital items, on other investments. You just sent me a WhatsApp. If I say maybe by tomorrow, of course,
okay,
in the notes, I've actually listed everything.
okay,
So just a 2 minute audio to just say, oh, Dara, my other investment items, or I mean, investment income include blah, 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 blah. Then to move
okay.
standard futhi repo, standard nongo download take a foot free online. If it's 18, you need to download that so that you know what we are talking about in these other operating expenses, other investment incomes. It lists almost everything there. So
Everything one. Okay.
yes, you need to be very, very comfortable because those are the the rich exam uh, question grounds. So
Yeah.
yeah, you need to be prepared in advance on the other investment incomes. Also refer to the notes. Then after that, we move on to profit before financing and income taxes. And I said this one is one of the mandated. Okay.
Yeah. Yes. Yes. Yes.
The last mandated is the profit itself.
Profit.
So we have got
Mm.
one, the operating profit is
Operating
mandated,
profit.
then
The
profit
profit
before
before
finance,
financing
and then
and
this
profit.
one. They are mandated.
Okay.
So under the income and expenses from financing activities, we've got interest expense on borrowings and lease liabilities, right? And then
Mm.
interest expense on pension liabilities and provisions. You can list them
Okay.
as
Mm.
they are. Do not bunch them. Do not
Okay.
bunch them because they exhibit different risks. You understand? So
Mm.
to bunch them, you are distorting the information. Even
Okay.
even the way they accrue is different. This one is
Mm.
specifically directly from money, from the money that was loaned, all right, or the monies which would have been paid through a lease, But when it comes to the interest aspects related to, pension liabilities and provisions, you discover that, you know, um, there is more of the measurement risks which are associated,
Mhm.
where there is a high managerial judgment, all right, through these pension liabilities and so forth. So they are actually different in terms of dimension, in terms of their attributes. So although they, by the end of the day, they are considered finance costs, but they are different in terms of liquidity characteristics, in terms of the risks associated with them. They are very, very different.
Mhm.
So we need to ensure that they are given their separate lines. Then profit before income taxes, yeah, then you have that total. I mean the total of the profit, and then you deduct the income tax expense. You come for the profit for the year from continuing operations, then loss for the year from discontinued operation. You make that adjustment, and you come to the profit. Please, this is just profit. Don't write profit for the year.
Okay.
Now, the other comprehensive section.
I think that's where I have so many challenges there.
Okay, don't worry, don't worry. Uh, we'll be together. So we'll start with
Okay.
income and expenses that will not be reclassified to profit or loss. Aspect of reclassification. There are items which cannot be reclassified to the profit or loss section. Uh,
Yeah, I following.
yes. The aspect of reclassification is usually what can I say? Is usually sanctioned by the standards. All right, the standard will tell you if there is a chance that an item which would have been reported in the OCI might end up be in the statement of profit or loss above. We might first
Okay.
of all recognize it now under the OCI, but in future we may recycle it through the SPL. So the items which cannot be reclassified include the gains on property revaluations. So property
Mm-hmm.
revaluations under IAS 16 are not going to be reclassified. The gains are not going to be reported in the statement of profit or loss under the operating activities usually. They're not going to appear there. All right. Let me just check to see if we would we were going we should have seen. Okay, okay. The appropriate section that might capture that is, or the
Other
head,
operating income.
the other
Mm.
operating income. Okay, that's where
Yeah.
we would expect to see those items which are reclassifiable or
So what are you
recyclable.
saying? So
Okay,
we are saying so you can
all
continue.
right.
Maybe I
So
can
we are
ask you
saying
after.
there is no way we are going to say the gains on revaluation of PPE are going to
Mhm.
be reported here. But there are
I
other
know that's
gains
fine.
which are going to be
Mhm.
reported there. But the revaluation gains are never going to be reported there. That's what we are saying. So
Oh, that's fine.
it's a
Mhm.
it's a way of organizing our other comprehensive income to say we have got the items which cannot be reclassified, and then items which can be classified, which can be
Okay.
reclassified. You can see that
Mhm.
when specific conditions are met, then we may reclassify them. All right. For example, exchange differences on translating foreign operations. So if we have got a foreign subsidiary, there are going to be some exchange differences. All right.
Yeah.
For example, you are having another company in South Africa. All right. That's a foreign operation. All right. So the exchange differences, when we are translating through the consolidation, when we are translating the operations of that subsidiary, we, we need to recognize the differences, the gains or loss in the other comprehensive income. But when we close that shop, when we close that subsidiary or that operation, we will then have to take these gains, the cumulative figures, into the other income section, the other operating income section here. They will come here. Are we together?
Um, can I say what you if said ipapa kuti isusu tinongoti apa pari kungoenda ipapa pamaka highlight apa pari
Uh-huh.
kungoenda the only translation gain only but the actual gain is actually going kunhingi ku other income.
We are saying as long as that foreign operation is still operating as a
Mm.
continuous entity, as long as it is
Yes.
still continuing, we will continue to recognize the gains or losses under the OCI, under the income, and so that will be reclassified in future. In future, we're going to reclassify when we close that branch. We are not going to reclassify now. At the moment, we are still going to continue recognizing them under this section.
Mhm.
But these items have got a potential of being reclassified sometime in future when we
Mhm.
close shop. Do you get it?
Yeah.
I mean, that is in respect of these items, these exchange differences. They're only going to be reclassified when that subsidiary closes. Then those gains are going to be reported in the SPL.
Okay.
Available for sale financial assets. So the gains or losses that accumulate on financial assets, which are considered available for sale, are going initially to be recognized in the other comprehensive income section of those items to be reclassified in future. Suppose uh, these available for sale assets meet the criteria of being reclassified, then we then have to reclassify them. If the criteria for that reclassification has been met, but if it is not yet met, then we'll still continue to recognize them here. But they have got a potential under Ifrs 9, they have got a potential of being reclassified in the future. Hello?
Yeah. I follow it.
Don't worry. When we will be doing the specific standards, because there is a select of certain standards. We cannot go into the SBR exam without doing financial instruments, without doing income taxes, without doing IFRS 15, without doing leases. We can't do that. We can't do that mistake without doing the employee benefits. Never. We can't do that. So don't worry about those.
Okay, that's fine.
All right.
Mm.
Losses on cash flow hedge is again an aspect of financial instruments. So all these have got a potential of being reclassified. But initially, for remember we talked of prudence, the aspect of prudence. so that we prevent managers, because these items are too speculative, they are subject to managerial judgment. So because of the speculative nature of these items, they have to be reported in the other comprehensive income with the potential of being reclassified in future. So just to preserve the integrity of financial reporting, they need to be reported initially in the other comprehensive section. Do you get it?
Yeah, I get it. Yeah, I think ndiri kutombosana nemaquestions ari kubvunza zvinhu izvozvizvi.
Umbosangana nawo naye.
Mm.
It's also. So also do not forget the income taxes relating to these items. The income taxes themselves also have to be given their entry. Then you arrive at the total incomes and what for these items there. So for those items which will never, we said the revaluation, the gain on revaluation, gains on remeasurements of defined benefit pension plans. This one is IS 19, like I say, employee benefits. We are going to look at that standard. Then share of other comprehensive income of associates and joint ventures. Remember, those associates, when they are preparing their own statement of financial performance, it will be having the profit, as we have just seen, like this. Their statement will be having like this, but because they are an associate of us, we are going to have the share of their profit, which is on this figure. If this was a financial statement of the associate, on this particular figure, we're going to have a share of their profit, which we are going to enter here as share of profit or loss of associate in our books. Do you get it?
Mm.
Then
Yes.
their statement as well will also have got a section called other comprehensive income, and we are going to take a total of that. Remember, the total of this figure, the total comprehensive income, we're going to take a share of that, share of other comprehensive income of the associate or joint venture. We need to put it there. Are we
Okay.
together? Do you get it?
I'm following. Ndiri
All right, good. And also, all the income taxes related to this should also be considered. All right. Kana tazosvika total comprehensive income figure panapa, tofanirwa kuzoita ma-attribution. We need to attribute the profit as well as the other comprehensive income. So, first of all, you need to come up with the NCI figure, the non-controlling interest figure first, and then for the parent becomes the balancing figure. You start with the NCI and then you come to the parent. The parent will be the last to get. Then you get the total profit. This figure should be equal to the profit amount, the profit figure, which is this figure there for the profit. Then for the total comprehensive income, you again first of all have to attribute to the NCI, and the parent is the balancing figure, and the figure you get here should be equal to the total comprehensive income you obtained there. You are done. And then you compute the EPS under IAS 33, earnings per share, where you first of all determine the basic EPS and the diluted EPS. You are done. And wakwendesa my finance, my financial statements to the board. Ningwa sins accountant. Understand?
pane pashanu.
All right. Management performance measures, MPMs. These are non-IFRS subtotals used by management in public releases outside financial statements. For example, adjusted EBITDA to track performance. To prevent misleading metrics, IFRS 18 requires full disclosure within audited financial notes. So kana pashandiswa ma MPMS. These are like I said, they are subtotals which can be found on primary financial statement, the PFS, but they are not sanctioned by the standard. But management might come up, whether because of the industry itself, the industry might recognize those subtotals as important. So they need to be adequately disclosed in the notes. What they mean, what they stand for, and so forth. So explanation of why the measure provides useful insights is required. Full reconciliation back to the nearest IFRS subtotal. So if the EBITDA is related, is almost closer to that mandatory, the mandatory subtotal, that is profit before financing and what? And investing. Profit before, okay, I'm coming, say, I'm coming. Profit before financing and income taxes. Remember this one. Maybe the EBITDA is closer to this one. You need to do the reconciliation, okay, between the EBITDA and that one in the notes, so that people will understand what you are talking about, the EBITDA and so forth. So full reconciliation back to the nearest IFRS subtotal, transparent calculation of tax and non-controlling interest impacts. These ones are required. Is that clear, sir?
Yeah, it's clear.
All right. So, just give me 1 minute. I just want to do what the boss wants me to do. Just 5 minutes, please. You might
I know
as
that's
well
fine. Thank you.
take a smoke break.
I know that's fine. Thank you very much.
All right. What's
Yes, how are you?
fine. I'm fine. I'm sorry for this hiccup.
No, that's fine. No problem. No, that's fine. I think in the territory says.
All right. So we are jumping over to IFRS 10. Uh,
Consolidation.
yes. This is please. Like I said, you need to research the exact names of these standards. Um, so that you just sound professional. Although you're not going to get any marks for citing specific names of the standards, but it improves your professional appreciation of the whole undertaking. So this standard uh, tells us more about consolidation, or about the controlling of other entities by other entities. So control is the sole regulatory mechanisms used to determine whether an aid must be consolidated line by line. Remember, I talked about the line by line aspect. For example, we are having the financial results of the parent and the financial result of another company, which happens to be the subsidiary. So if you are looking at the revenue, we'll need to add the revenue of the parent as well as the revenue of the sub to get the total revenue of the group. We need to add. So that's adding line by line. Okay. So consolidation is an act of adding line by line.
Okay.
All right. So for you to consolidate the financial results of another company to you, you need to determine if there is power. Okay. So power is the ability to direct relevant activities, the operational choices that drive financial performance. Do you have the power to direct relevant activities? So when you talk of directing, We are actually talking about the power to appoint the people who can direct. For example,
Mhm.
I mean, for example, to appoint the majority of the directors. All right. But that one is driven, like I told you, from largely from the shareholding, also from the from contractual relationships. Sometimes you discover that a company might be holding uh, less than 50%, for example, 40% of the shares, but it is considered a parent of that of the investee, but they have got 40%. This is because the other shareholders might be extensively dispersed. For example, you might have other shareholders might be having maybe 2%, the others 3% shareholding, others maybe 20%, and so forth. So if the bigger one has got 40%, technically they are the parent. They are the owners of that company, even if they are less than 50%. Do you get it?
Yeah, it's fun. Yeah, I get it.
You get it?
Yeah, I get
Or
it.
sometimes they might be having 40%, then others have got also 40%, and the other one maybe 5%, 10%, and so forth to come to 100%. So, but these other ones, even if they are equal, because the parent can't be two parents. So there could be a contract that gives another one of the two the power over others. Do you understand? So if there is a contract,
Mhm.
if there is a
Yeah.
contract that specifically says this one is our boss, even if in terms of shareholding you are equal, that will be the parent. Do you get it?
Yeah. Maybe I would also appreciate if I might link that one to the likes of another EcoNet, for example, Eco Cash Group, to say kuti ine ma-entities akaita sanana EcoSure, Mova, Vaya, nechichi kuti iyo kunzi izonzi yakuconsolidata kuma-subsidiary ayo, for example EcoSure, that means iyo inenge ine much or above mashares ari kune vamwe wari invested imomomo saka toti iyo ine 40, maybe wamwe ane ma 10 10 10 10 10 10, iyo ine 40 ndo yepamusoro pewamwe.
Ndizvozvo. Chero pasina contract, but kana vamwe vanhu vacho vari so varied, for example, and dispersed, for example, vakaita like any 40%, but vamwe ava 60% is constituted by vanhu vane 3%, 10%, 5%, something like that. Then the 40% shareholder is actually the parent. So
Okay.
iyoyo ndo inenge yakuconsolidate, ndo inoconsolidate. Vamwe ava vese ava, if they are a subsidiary, they cannot consolidate. Adira,
Yeah,
do you get it?
I got it. Hmm?
All right. Now, so if it has got um, access to variable returns of the investee, it can also consolidate. All right. So
Mhm.
direct exposure or ownership rights to variable returns, gains or losses from the involvement. So if a company has got that exposure to variable returns, why are we saying variable returns and not fixed returns? We are simply saying this company has got the variable, has got enjoyment. When the company makes profits, it gets more profit. When company gets losses, it gets uh, the relevant losses. It is exposed to those losses. When things are bad, it is going to be exposed to the bad situation. When things are good, it's going to be exposed to the good situation. So those are variable returns. So if you are exposed in such a way, in such a manner, then you are the owner of the business. Kana zvinhu zvarinaka unowinawo zvakawanda, unongowinawo zvakanakisisa zvacho izvo kana zvakanaka zvacho. Kana zvadhaka you are different from those shareholders where they are only going to be exposed to fixed returns. Do you
Yeah.
understand?
Yeah, unongoasasikwa.
So you are the owner. So in that case, you have to consolidate. Then
Okay.
the direct ability to use personal power over investee to alter investors' returns. For example, zvatambotaura zviya zvekuappointa vanhu and so forth. Unotodetermina kuti vakomana this time varanhingi nanhingi endai mundoita zvakati because ndowakawaappointa. Toti mudai so zvakati zvichizvisiyai and so forth, unopa maorders. So in that case, you have the right to consolidate their results. Okay. Let's talk of the de facto control. Control can exist without holding over 50% of voting rights. We talked of dispersed shares. Occurs when a minority block, for example, 45%, faces thousands of unorganized individual investors who do not coordinate their votes. And kwakawanda singaiti ukatarira macompanies akanakaita sana OK Zimbabwe udiscover kuti mune mashareholders vamwe vana baba vedu vaitoti vakatengawo mashares but anogona kunge ari 0.0001 but vaitodhurirwa kumatenga mashares iwayo 0.001%.
Unongoatenga nemari.
Akuchoti watotenga nemari kwayo onanga watotenga kana kuti maybe those days vamwe vaitoti matenga kana kuti not even $1,000 but $1,000 inenge iri 0.0000. You see
Yeah.
percent 0.000000%. You understand? So then kozongoitawo maybe vamwe vanenge vaine kana kuti anenge aine kana kuti 40%. Anditi vamwe vaine ma 0.11 vamwe ma 1% vanowachi iye ndiye parent iye. All right. Then contractual options, substantive conversion rights, or board composition clauses can establish control. So be careful here, because a question you may be given a scenario where directors are discussing and so forth. Some are saying you cannot consolidate us because of A, B, C, D, and so forth. And some are saying, oh, there's this particular contract and so forth. So the examiner asks you, can subsidiary B be, or can company B be consolidated? You see, all those things should give you some, indicators.
Okay.
So let's talk of business combination. Can we combine these businesses as one? So you need to establish the case for a combination, because it is from the identification of the combination that would also give you the idea of coming up with a consolidated financial statement. So Ifrs 3 gives us some distinction. Asset acquisitions do not create goodwill or generate deferred tax liabilities at the acquisition date. So we are simply saying that there are certain, you might tell yourself that we have bought a company. When you haven't bought a company, you need to buy a business, not simply buying assets to say that you need to consolidate them. All right. So you need to establish if there was a business activity. Here they are preventing a situation where to lie to investors that it's a large group. They've bought another company and they've also bought that one. So they are actually a growing group when they are not actually a growing group. There are people who are just buying assets with no business significance.
It
You
is.
need to, it should be a business that has been bought, not an asset that has been bought. Do you understand? So we look
Mm.
at the inputs plus the substantive processes. So there is what is called the concentration test. If substantially all the fair value of gross assets acquired is concentrated in one single asset, is it is just going to be treated as an asset purchase. For example, the business erangotengwa yakaingoriwo zvayo mine yakagara, but hapana the mining itself or the mining processes which were being carried out. Wangototenga a mine claim, wototenga another company, hapana zvinhu zvambenge zvichiitwa. You understand? No business that has been operated. You have just bought
Oh.
something that was just lying idle. So you can't say we are now want to consolidate, the results of that because there was no business at all. Inongowa asset yamandotenga.
Mm. Saka ipapo tangotenga tinoita kungo
The country that is do you must not calculate goodwill, no goodwill, and so forth. You just have to recognize an asset in your books, a direct asset.
okay, like tangotenga assets. Oh
Asset
yeah.
yamangotenga. You understand? Whether the
Mm.
matenga for the purpose of consolidation or business combination, you haven't bought any business. For consolidation to take place, there should be a business which has been bought. So company A should actually be a business running. Okay,
Mm.
there should be
Yeah,
a
so
business.
I think I need to ask you to how exactly should we can you say that no because wanouya vese vachingoti this is a company for example mine iyoyo yacho inoti vanonga vachitoti tiri kutsvaga but tiri kungoshayawo maybe iri kuita malosses.
Zvinozivikanwa kune anonzi startup business richiri but pari kunzi so panofanirwa kunge painewo masubstantial business processes. For example,
Okay.
pane maemployees atoripo ari kutosenza something, inogona kunge isati yatanga
Okay.
kuita profit. Handiti
Mm-hmm.
zvotoziva, inogona kunge isati yatanga kuita profit, but
Mm-hmm.
panofanirwa kunge pachiratidza kuti pane mabusiness processes which are happening.
Mm-hmm.
Simply just buying an asset on its own, for example, mangosvika pane mainputs ndo maassets iwayo mainputs, but
Mm-hmm.
hapana some process that is converting those inputs to outputs. Do you understand? Anongwa mainputs
Mm-hmm.
amangondotenga ga pangosvika panongwa neclaim iripo apo, ndipo ndiyo yachona it's a gold claim yamangoona iri kutonzi Musa Limited, vanenge vane gold claim yavanayo.
Mm-hmm.
Andika, it is the claim itself is having a gold reservoirs amounting to $1 trillion.
Mm-hmm.
Right? So we want to consolidate, but mofanirwa kuzocheka kuona kuti are there some substantive business processes that are happening.
Mm-hmm.
Maibata beta.
Yeah. Yeah, ipapo yeah,
Vanogona kunge vasati vatanga kutengesa gold ravo, it's okay, they are still in a net loss position, but they can be consolidated. Right, they can be consolidated. All right.
okay.
Yes, kana kuri
Mm.
kuti patori nevashandi vakutoita zvinhu zvakawanda, administrative processes are happening and so forth. Extraction is happening, or even they are still in the research phase. Vakomana vacho my research costs have been incurred, varikutoita zvakati with some substantive business ideology or processes happening.
Mm-hmm.
Maibata message.
Yeah. Ko apa pakanzi assets acquisition pagoodwill apa maybe ndichanhingiriki nazvo ndichazokunyatsa kubvunza zvangu mberi.
Okay, asset acquisitions do not create So we are simply saying, if you are just buying an asset, please do not calculate goodwill. All right, goodwill is calculated when we have bought a business. We calculate goodwill. When you have
Okay.
acquired another company, when you have acquired a business, you need to calculate goodwill.
A
All right.
functional company. Yeah.
So you can't
Yeah.
calculate goodwill if you have simply bought an asset.
That's it. Yeah. I baba pari clear. Baba clear.
Yeah.
Uh,
All right. We talked about that one. Then let's talk about, remember, goodwill. Let's okay, for the avoidance of doubt, to calculate goodwill, because I've highly summarized these notes for the purpose of presentation, but the notes I've given you have got all these formulas. Um, so to calculate goodwill, that's purchase consideration. Okay, you have got the purchase. Um, if you don't have a tablet, it's very, very difficult. It takes a lot of time. So there's the
no, I
purchase.
got the PC.
Okay, even the PC, right? PC, okay, which is the purchase consideration. That
Mm.
is X amount, X dollars, right? Um, and
So
then
this is the amount which you agreed to buy maybe a business or something. Purchase
yes,
consideration, though the total amount which you agreed to pay.
to pay, and it can be
Mm.
paid in cash or share for
Mm.
share, all right? Or
Okay.
it can be a deferred consideration. There are a variety of ways of paying this purchase consideration, and we'll talk about those ones as we proceed uh,
Okay.
in this today or in the coming lecture. We'll also talk about them, right? And then if it is not 100% subsidiary, then you need to add NCI. For example, you might have bought 80% of the shares, all right. So you need to add the NCI amount, and you'll be told whether the NCI is based, whether it is group policy to value NCI at fair value or at the proportion of net assets. You'll be told. So NCI, you need to add that amount for the NCI, then less what are called net assets at acquisition, less net assets at acquisition, less net NA at acquisition, the net assets at acquisition. This formula is very, very important. Then you get what is called goodwill at acquisition. This is goodwill at acquisition. Then at the end of the year, you need to assess if the goodwill is impaired. So sometimes it will be impaired, and you then have to say less impairment of goodwill, less impairment. So you can't do this, the computation of goodwill. You can't calculate goodwill if you have simply bought an asset. Ndozvirongotogwa standard. So this is goodwill at the end of year. But usually, this is the figure that is required at acquisition. At acquisition. At acquisition. Right. End of year.
No reporting date.
Yes, at reporting date. Machubate mkoko.
Yeah, I'm
Pakuti
following.
ngozvitaura panapa because togona kunge tisina kuzvikavha, but tangozvitaura. Chinongo chifomula chongogarawo nacho.
Maybe panichazonyatsa kuzodzoka hangu ndepekungozoti pa NCI apa nepaless NA apa. I think ndichazoti maybe during question ndakunyatsa kubvunza question.
All right.
Mm.
Togona kuzombopabata. It's okay.
It's okay. But
All
for
right.
now,
Let's
it's
talk of
okay.
associates. These ones who will be having significant influence, and we talked about this. An associate is an entity where the investor exerts significant influence. This is mathematically presumed with a 20% to 50% voting stake. Saka aningangoti ma-associates iwayo. Qualitative indicators and exam application. There was this particular example. Okay, in your notes there is this example of VADA and RAIN. VADA acquires 90% of RAIN but secures 2 out of 8 board seats. So voting power is equal to 25%. Conclusion: board representation overrides the 19% shareholding. Remember, we said any shareholding that is below 20% is a simple investment. However, because if you look at the ratio of directors of voting power here, 2/8, this one is significant at 25%. So significant influence is established, and REN must be equity accounted. Equity accounting simply means that we need to take the share of the associate's profit. That's equity accounting, isn't it?
Yebo, yes, yes, apa zvazvakapinda manje.
Maibata here method.
Zvano- Zvanopindira panhingi apa panhingi isati echiti profit yawo inenge
The,
associate yakunopinda
so
paya pamabiro.
so we are simply saying if the associate made a profit of say 2,000, if they made a profit of 2,000, our share will be multiplied by 19%, 19.9%. Ndio tinondo reporter kuya kunonzi kupi ku statement of profit or loss maibata under investing activities
Investment paper. Okay, yeah.
maibata good asi kana
Yes,
kuri
so
ku
you're
balance
20.
sheet kana kuri ku balance sheet now ku statement of financial position we are going to say the cost plus this amount. We're going to say cost investment yacho perhaps takatenga this associate at 2,000 or maybe let me just say at $200,000. So we are going to say $200,000 plus the share of profit we get
Data
there.
calculator.
Eh,
Okay.
Maibata message, good. Group consolidation performance under IFRS 18. Goodwill presentation must be presented as a standalone, separate line item on the face of consolidated statement of financial position. So you are required to present this goodwill as a separate line. Do not bunch it under the non-current assets to simply say non-current assets. Then you put the goodwill, add the goodwill to that amount instead of writing the goodwill. That would be wrong. You need to put the PPE line on its own, then goodwill as a separate line. It has to be presented separately. Investment in associate amount presented as a single line asset calculated via the equity method, which I've just explained, where we say that the carrying value will be the cost of the associate, the original cost, plus post-acquisition profit, minus any inventory provision for unrealized profit. Remember the intra-group transactions, minus any cumulative impairments. Then you get the cumulative value of the associate in the SFP. Operating expense choice. Presentation by nature or function must happen on the face of profit or loss statement, not hidden in the notes. Right? So you need to be careful where we say that everything has to be presented on the P&L, not to hide it in the notes. You need to present everything in the notes. I mean, in the statement itself.
Okay.
Okay. The group profit or loss presentation, the sections are going to be the same. We need to have the operating section, the investing section, the financing section. But remember, for consolidation, we're going to say to have the parent results plus the subsidiary results minus internal sales plus inventory PAP adjustments and fair value depreciation. And this should give us the result of operating profit or loss. Then the investing section, dividend income from financial instruments plus group share of associate or joint ventures, and we come to profit before financing and tax. Then we come to financing section where group external interest costs, those borrowings and so forth, lease obligations, IS 19 pension interest adjustments. Then we get the net profit for the period. Remember, I said this should be written profit, not net profit and so on, but just profit.
Okay.
Group consolidated adjustments workflow. The intragroup tradings, you need to eliminate 100% of internal revenue and cost of sales. Keeps performance lines from blowing out without impacting net profit. So we are simply saying that my intragroup transactions have to be eliminated. Inventory provisions for unrealized profits. These ones increase cost of sales. You need to increase cost of sales so that you eliminate unrealized profit margins on unsold internal stock. So if there are some intragroup tradings, so what you need to do, usually the one company within the group is going to sell to another company at a profit. So we are being told that on the remaining stock which has not been sold out, there is unrealized profit. One company is telling itself that they've made a profit, but that was not a profit because they are related companies. So we need to remove that unrealized profit. How do we remove that one? We need to increase the cost of sales by that profit. By so doing, if we increase the cost of sales, we would have eliminated the profit. All right? Those open up. Impairment track.
Okay.
Subsidiary goodwill impairment drops into operating expenses. Associate impairment reduces the single investment asset line inside investing. So you need to know the impact of impairments. Goodwill impairment is going to affect operating expenses, but the investment in an associate might be impaired. Okay, might be impaired. So the impairment itself is going to be reported under investment in the investment activities, the investing activities. Are we together?
Yes. Papa, I think maybe Japan just after a question.
All right. Okay. Fine. Here we're having this particular question. Question one, where we are supposed to do the goodwill computations. Remember, I gave you the formula. So here we're given the financials of the parent P and the subsidiary S. It's a statement of financial position, this one. These are statements of financial positions or financial position for two companies. So
Okay.
the cost of the investment in S is recorded in P's books. So do not question and say, why is S not having, sometimes S might be having something if S also owns another company. We will touch on those aspects in our coming lecture. That is next week. So this is the cost of the acquisition of S. All right, investment in S. All right. So the rest are non-current assets and assets. All right. Then we move to the share capital of the parent and share capital of subsidiary, the reserves, and so forth. Then current liabilities, non-current liabilities. We are given this additional information. P acquired 80% of S when S reserves were 40. So they were $40 when they were acquired. So at the date of acquisition, the reserves were 40. Reserves include retained earnings and so forth. So you may say the retained earnings were 40. At that date, the fair value of S net assets, the net assets, usually net assets include the share capital and the reserves. Okay, share capital and reserves. These are the net assets we are talking about. So when this S was acquired, the net assets were 150. But if you are looking at this particular reporting date, they are almost how much? They are now 500 in total. Do you get it?
Yes.
All right. So the trick part here is that when they were acquired, they were 150. And the examiner is telling us that the difference is due to land. Difference between what and what? This is the difference between the fair value of net assets at acquisition, all right, which was 150, and the fair value in terms of the theoretical value. All right, what am I saying here? All right, we are told here that I've just indicated that the net assets include the share capital, okay, the share capital and the reserves. So, and the reserves are the RES, please, that's the reserve. So, the share capital usually don't change, is considered a constant. So, the share capital does not what? Does not change. The share capital of S is going to be assumed to be constant. So it was 200. All right. It was 200 when it was acquired. So we say the share capital was 100. Okay. And the reserves, we were told that they were how much? They were 40. But at this particular date, the fair value of the net assets was 150. Was 150 according to the question. Because we are told that at that date, the fair value of net assets of S was 150. So the difference is due to land. And what is that difference? The difference is 10, isn't it?
Mm.
Do you get it? So
Yeah.
you need to say land fair value uplift. Land fair value uplift. That's 10. Sometimes they'll tell you that there was an item of building which was undervalued by 10. So if it is building, then you need to consider the depreciation amount at the year end. All right. But for the purpose of calculating goodwill, we are looking at the net assets at acquisition. So these are your net assets as presented here. Now, this figure is very, very important because it is going to affect your statement of financial position. So be careful. There have been no issues of shares since acquisition. So we are told that just assume that the share capital is going to be constant. Is that clear?
Yes.
P uses the fair value of net assets method at acquisition, and at acquisition, the fair value of an NCI was 35. No impairment of goodwill. Prepare consolidated set of accounts. Zvakachiba. So tobatawe pana and it. So at acquisition, don't chataita ichi. Then outungoona and because at acquisition we said the share capital was constant at 100. The retained earnings at acquisition were 40. and the fair value adjustment was 10 to come to 150. Now it's reporting, as we have seen, they are now 100. As usual, share capital is not changing, but retained earnings are now 400. Okay. Of course, the fair value must not be ignored. A lot of students usually ignore to put the fair value here. So the total net assets is now 510. Hello? Are you
Okay,
there?
so I think you can highlight me again on 400. It's
Okay.
clear. It's written
The
there.
400 is this one is at reporting date. Remember this.
Oh, okay.
This is
Okay.
at a reporting date. You are going to be given, usually you are going to be given the statement of financial position at reporting date.
Okay, so that one we just wrote it reserves. Uko yakanyorwa retained on
Sorry.
the answer. Retained on the answer.
Yeah. Yes, I said reserves include retained earnings. Be careful there, right?
Oh,
So here they simply say retained earnings. That's fine.
okay.
Those are the reserves we are talking about. All right. So you then have to account for the movement. You need to see which one has changed. The share capital has not changed, is zero. The retained earnings have moved from 40 to 400, so they've moved by 360. The fair value uplift is considered also to be constant. Okay, so um, we are having the total net assets movement, the post-acquisition movement or post-acquisition profit of 360. All right, that is the gain which we would have enjoyed post-acquisition. All right. So the first thing is to calculate goodwill. So we are told that the consideration which was paid was 120. How do we know that this is the cost of the investment? They paid 120. Have you seen that?
Yes.
Good. So that's the consideration. Remember our formula, purchase consideration. At NCI, at acquisition, we were told that it was 35. We need to add that to the purchase consideration. Remember, all right? So we are told that the NCI at acquisition was 35 there. So if you know your formula, if you know your template, it is going to be very easy. And I've just given you the template. This was the template we talked about. Purchase consideration at NCI, less net assets at acquisition. At acquisition. At acquisition. Please. NCI at acquisition, then you get your goodwill, less an impairment. Very, very simple. So purchase consideration 120 plus NCI 35 less net assets of 150, right? And we get the goodwill of 5. After that, you need to compute the non-controlling interest. Non-controlling interest. NCI at acquisition, we are given the figure as 35 plus NCI post-acquisition profit. Remember, the post-acquisition profit was how much? 360. So this 360 includes the parent share as well as NCI share, the non-controlling interest. And this one was an 80% subsidiary. So the parent is entitled to 80% of the 360. 80%. Right? And NCI is entitled to 20% of that profit. Are we together?
Yeah.
So this is why we are saying NCI post-acquisition profit should be 20% of 360. That is 72. So it's added to 35. Then less any impairment. We are told that there was no any impairment, so we are going to come up to NCI of 107. Then this is now the final group statement of financial position. We are going to start with the non-current assets. Like I said, we are going to add line by line. So if we come to our group, to our statement of financial position, the non-current assets, we're going to add the parent's current assets, the non-current assets of 500, plus those of the subsidiary, the 600. And we only have to factor in then the fair value uplift of $10. Okay, to get our total assets. I'm sure that's what happened here. Yes, that's 500 plus 600 plus the 10,000, the 10 to get it. Hello.
Oh, sorry. Yes, I get it. $10 of that fair value up adjustment
Lifter.
uplift.
Yes. Then when it comes to the goodwill now, we are no longer going to in the consolidated financial statements, this entry is not going to be seen. It is not going to be seen. We are only going to see goodwill, only goodwill entry. And we have calculated the goodwill as how much? The goodwill was 5. So that's the entry we are going to see. These are the consolidated entry. This is the consolidated SFP. So we're going to only see the $5. All right.
No, that.
These ones are not going to be, these ones are not the consolidated. All right, but they are only put here for you to see what we are doing. All right,
Okay.
but the consolidated SFP is this one. Then current assets, we are going to add as usual from the original balance sheet. That's 100 plus 200. These were the figures, please. These were the figures. That's the 100 plus the 200. And no adjustments were made there. All right. So this is the same figure, 300. All right. Then you sum up, you get your total. Then we come to the other side, the group reserves and equity. Remember, we are only going to take the parent share capital. Please. Please. It is only the parent's share capital that is taken. Do not add the two share capitals. Okay.
Yes, I'm taking note of that.
Only the share capital of the parent. So the share capital of the parent, and then the reserves. The reserves, that is 508. All right. One might be lost and say, how did you arrive at the reserves of 508? All right. You need to do, there was supposed to be step number 5 where we look at the retained earnings, but we can do the computations. We can do
Also,
the
step number 3.
yes,
Step number 3 and carry
yes,
on.
step number 3, right?
Mhm.
Which is missing there. But don't worry, we can squeeze it. Let us construct it. First of all, you start with the parents own the uh, parents own retained earnings, parent
Mhm.
RE. How much were they? The reserves for the parent from the question.
Um, from the question
That's
of I think
You're not
It's
concentrating. That's
two
220, right?
220. Yeah.
220, right?
Mm.
So we have 220.
That's for parent.
Yes, for the parent. Now, for the subsidiary, we are going to take the post-acquisition profits percentage. Remember, of the 360 here, 20% was taken by NCI. Do you get it?
Yeah.
Remember, remember the subsidiaries retained earnings have been considered here already.
Mm-hmm.
So we are worried about the post-acquisition. How much are we entitled of the 360? We are entitled to the 80%. So we are going to take our share of subsidiary profit, share of subsidiaries profit. How much is that? That's 80% of 360.
Mm-hmm.
How much do you get?
80% of 360. Let me
80%, 80% of 360.
of 360.
Yeah,
That's 288,000
that's 288.
or million.
Okay, good. So let us now add these two figures. And how much do we get? 220 plus
Plus
288.
220, that's 508.
That's 508. So you saw where the 508 came from, right?
Okay.
These reserves.
Okay.
Do you get it?
Yes, I get it.
That's how we obtained the 508.
The reserves.
Then you add also the NCI. Okay?
Yes.
So you can see that the total assets, that's 1,110 plus $5 plus 300, you must arrive at 1,415. And this should also equal to 100 plus 508 plus 107. And you must arrive at 1,415. That is, you also have to consider the group liabilities, right? Of 700. Remember, that's equity plus liabilities, and that's
Mhm.
equity plus liabilities. You need to add the group reserves or equity plus liabilities to come to 1,415. That's total equity and liabilities. Are we together?
Yes, we are together.
Grow. So, I mean, good. So we have actually done the consolidation, the basics of it. Now, sometimes the examiner might tell you that the goodwill is based on the proportion of NCI. It's not um, a full a full goodwill method that's going to be used, but the proportionate method. So in that case, the NCI will be based on the percentage of share of net assets at acquisition. You still have to follow the same thing, but the only thing that is going to be different is when we are going to treat the impairment of goodwill, impairment loss. But everything will just have to be the same. Is that clear?
Mm. Yeah, it's clear.
Good. So if we are using full method or the full goodwill method, Goodwill is attributed to both parent and NCI. All right. Impairment losses are split across both balances based on ownership percentages. So the relevant, if there is an impairment loss, you're going to debit, the relevant journal, you're going to debit retained earnings. Okay. That is a piece percentage of impairment. All right. So let's say the payment is $200. So you're going to debit the retained earnings by the percentage of shareholding. That is, if it is an 80% subsidiary, you're going to say 80% multiplied by the impairment loss as a debit to the retained earnings, and debit NCI with the NCI percentage of the impairment, and you are going to credit goodwill 100% of the impairment. But if we are using the proportionate method of impairment, the proportionate method of goodwill, the entry here, the goodwill is recognized for the parent only. To check for impairment, you must first gross up goodwill. However, the final recognized impairment loss is allocated 100% to parent reserves, leaving NCI untouched. So what you're going to do there, you're only going to affect the parent. You're going to credit goodwill by the parent percentage of goodwill and credit subsidiaries other net assets, and then you are going to debit profit or loss as a balancing figure. The rest has been actually spoken in your notes, the notes which I've given you. I've actually put a lot of examples there, which you are going to relate. All right. So the Acca XBR exam strategy and core updates. IS 8 realignment. Core preparation rules like going concern and estimation uncertainties have moved from IS 1 into revised IS 8 framework. Ifrs 19 relief. Eligible unlisted subsidiary can now use a reduced disclosure footprint if their ultimate parent provides public Ifrs compliant accounts. So, which means that if you are a company, you're just as a subsidiary or a small subsidiary, and your mother, your parent, is actually a listed company, you are no longer required to also produce heavily detailed notes. Financial statements. Why? Because your subsidiary, your parent is doing much of the work. All right. So they don't want. They've actually lifted the burden from small companies. So expect spreadsheet correction tasks in question 1. Be ready to reclassify misallocated entries out of the operating category into financing or investing under IFRS 18. Usually, this will be required in your examination to do, so that you show the examiner that you understand what is going on. So this is why we have actually grouped these things all together on one place.
Okay.
Thank you for following the IFRS 18 mechanics and consolidation process. Please do not forget to tell your friends, peers about Transcribe Business School. Maita basa tinotenda chose ameno kana muine mubvunzo.
Ndakenda mboverenga first.
Handiti saka takupai questions, I think matatu or kana asiri 5 matatu they are short questions actually. Toti mungoita kana maita motisenderawo pa WhatsApp tukasira kumaona nekumamaka hatsi bhinorohwa ichapisa handini kati gagaga. Saa zvizhinji zvinenge zvatinge like assignments, kana musati mamaita it's fine, togonombomasiya tomboita current this week and so forth. We want to make sure kuti tofanira kunge tapedza by week number 6 tofanira kunge tapedza zvese zvinodiwa mamwe mastandards tinomakavha during revision phase. Panonzi revision phase ndo patinokavha zvimwe zvatisina kubata during the study journey, handitika. tozvibata ipapo pakurivhaisa tinenge tichitozviataka tichitoona kuti munhu wese ava up to handiti maona metsi yacho.
Yeah.
Saka ngatirove basa, ngatitei the current week's task. Mukakwanisa kutitumirawo by Thursday munenge magona, so that toona time yekuti tizvimake, then Saturday totanga something new.
Okay, so tichipinda futi mumaconsolidation but ma-complex ones.
Ndatopa neimwe stage takutoita ana step consolidation what all those things. Saka togona kurova futi consolidation, charova consolidation, advanced groups. Next Saturday titatopinda paadvanced, apa tatorova pabasic yatopera. Maibata maizazvo zvimwe zvachona munenge mutozviimprovawo muri mega muchitoona, because apa tanyanya kuconcentrata kustatement of financial position, but pane statement of financial performance, but taitaura tichigodiscassa, handiti maona tichitarira mapresentation and so forth, totozvibata ipo paya, but chinenge changosara chete kuzoita the actual figures muchiweka muchiona kuti zvakamira sei. Ndichatry futi kukutumiraiwo imwe video yandakamboita for vari kuita financial reporting yanga ine statement of financial performance, mumboona kuti zvinoitwa sei and so forth. Then kana zvadaro afu tinenge tichitofamba tichitoenda.
Yeah, it's okay.
Ndatenda mambo wangu. Zvakanaka.
Okay, thank you. All right,
Ciao.
thank you.